Geoffrey Dennis, independent emerging markets commentator, Johnson right now on the show. It's always a pleasure talking to him. Good evening, Jeff. Thanks so much for taking the time out. Did you, in your wisdom, anticipate some concrete comments come out within day one, or do you expect this to happen later on as the meeting goes on, if at all?
I think it'll take a couple of days, maybe 3 days, and even if we get some sort of deal, I think it'll be a pretty low-level deal. It will not resolve all the issues between the US and China. A few minutes ago on the program, you talked about China agreeing to release more exports of rare earths. That's incredibly important to the United States, given their use in things like batteries and solar power, etc. And on the US side, easing some of the restrictions on key semiconductor chips going to China. That seems to be a sort of low-level agreement you could get, but you are not going to get a wholesale trade deal between the US and China in a short period of time. And I'm not sure the tariffs will come down much, if at all. So I think there's a lot of scope for the market ultimately to be disappointed about this, because you don't just pluck a US-China trade deal just out of the air in a couple of days of conversation. And there's a lot of very thorny issues that need to be discussed and resolved.
Right. Jeff, good morning. Hiral on this side. Would you say that there is some optimism and a lot of caution over here, taking into consideration that you have Wall Street, where the rebounds that we saw is cooling off. The dollar has remained pinned near the April lows. China also seems to be under pressure because the exports to the US from China have actually plummeted by almost around 35% in May, if you have to compare it on a year-on-year basis. And again, this is the impact of the tariff war. How would you summate all of this, and how should investors then react?
First of all, I think we should assume the sharp drop in Chinese exports to the US will, A, be probably temporary. This reflected, of course, the initial huge tariffs that were imposed between the two countries. Secondly, what China is doing, of course, is selling through third countries like Vietnam and in Mexico, getting their products into the US that way. And so I don't think this is really going to affect very much the US overall trade deficit. It may impact medium to long term the US-China trade deficit, but it won't resolve the trade deficit itself overall, and which is driven, of course, by the high level of US spending relative to the low level of US saving. And that's just a macroeconomic fact. Now, I think the markets have got well ahead of themselves in the short term. Everyone's getting very excited about all these various trade deals, including China, that could come in the next few weeks. I think we've got a long way to go on these trade deals. The tariffs are still there. They're going to be restrictive for the US economy. They're going to push inflation up for a period of time as well. And therefore, I think the equity markets have got a little ahead of themselves. And I'm pretty cautious about certainly the US market in the short term, because it's just very hard to get these trade deals done in any sort of speed.
Okay, so Jeff, cautious view coming in terms of US, though there are some bit of indications that there is intensified effort by the US as well to conclude some of the trade deals. We're talking about China right now. By 9th of July, which is the deadline for reciprocal tariffs, probably deals with India and Japan that could be in the limelight as well. Taking this into consideration, which are the markets that you would be positive on if you're cautious on US right now?
Well, first of all, I would say if you're not going to get many trade deals, or there's going to be disappointment about the number of trade deals by July the 9th, I wouldn't put it at all beyond President Trump to say, well, we're going to extend the delay on the reciprocal tariffs for another 3 months. So in other words, July the 9th seems like a deadline, but will in truth be a deadline in practice. I think this is still, as I've said on the show many times in the last 3 or 4 months, I think this is still a very good environment for emerging markets. EM is up about 11.5% in dollars this year now. Developed markets are up under 6. US is only up 2. And I think the key driver here is undoubtedly the weaker dollar. And although, as you rightly say, it's flattened off recently, down about 8.5%, 9% on the year or year to date, I think the dollar is eventually going to start to go lower again because the US economy, I think, is going to stay soft for a period of time. Within the emerging market space, I still am very wary about China because of the property story and also because you're seeing this very difficult switch from exports and investment spending towards the consumer, and exports themselves are under pressure, of course, now. I think India looks great for the long term. I think Korea looks a good market still to extend its recent gains. It's a value play. Taiwan will be tied in with the US tech sector, so that's a little bit of a concern there. I like Brazil. I like Mexico. I like parts of Central Europe, etc. So those would be some of the markets I would look at. But the most important thing of all here, I think, is as long as the dollar continues to stay weak, and weaken further, you'll see emerging markets doing fairly well. And in that environment, you'll see a lot of, you'll see gradual strength in EM currencies, which have already been strong in a number of countries this year, which will allow some of these countries, Brazil's a great example of that, to cut interest rates and cut interest rates significantly. So that's where I think the scope to make money, not in the US at this point in time.
Got it. Jeff, I know you track EMs very closely, possibly even now. Maybe not as much as you used to when you're wearing the professional hat, but maybe you still do. Just wondering. India has kind of recouped a lot of its earlier losses. In fact, post the Reserve Bank of India policy statement, there has been a really strong up move as well. Is it fairly valued or fully valued, or would you reckon India could get a further premium because it is one of the best growing or the fastest growing large economies, and the policy move seems to be behind growth?
I like to think I'm following just as much as I did when I was in a full-time job without the constraints of the compliance department. But anyway, that's another story. I think India looks really good. And the reason I think India looks good, first of all, you're in a very nice sweet spot at the moment with inflation having come down sharply. I know the rains have helped. And that's allowed the RBI to cut interest rates surprisingly sharply. I guess it was last week. And I think that's very, very important. I think it is pretty fully valued, but then India always is, so to speak, although sometimes it's overvalued. And I think given the strong growth story, it is a better place to be over the next, let's call it the medium term, 6 to 12 months, than is China. Although China may get a bump, of course, if you do get some sort of trade, quote unquote, deal between the US and China over the next few days. I think the other point I'd like to make about India, and I think foreign investors will be watching this one very carefully, is that, of course, if oil prices stay on the soft side and maybe weaken further, depends in part what OPEC does, that's very helpful as well. So although it's taken a bit of time for there to be a steady flow of foreign investor money into India again, I think this is a relative underperformer this year that I think has got a very good opportunity to do well over the next 6 to 12 months. Most importantly, as I say, I would prefer on that sort of medium-term time frame India over China without any question.
Right. So India in a sweet spot is what Geoff Dennis is looking at from in the emerging market.